New bill on the surcharge tax proposed by Minister of Finance Basil Rajapaksa via Budget 2022 was gazetted and published yesterday. As per the bill, any individual, partnership or company whose taxable income is in the excess of 2 billion rupees for the year of assessment starting from the 1st of April in 2020 will be charged a 25% surcharge tax on their taxable income. However, in case of a partnership, the income of a partner derived from a partnership shall not be taken into account when calculating the taxable income of such partner as an individual if the tax has been paid by the partnership on such taxable income. Further, each company of a group of companies of which the aggregate of the taxable income of all subsidiaries and the holding company in that group of companies having an income over 2 billion rupees, a 25% surcharge tax will be charged on the taxable income. As such, AdaDerana English News spoke to a tax expert to get a clear understanding about the bill.
In this imposition, there is no relief for what is called marginal relief in taxation. That is, if a person earns 1,999 million, he does not pay anything. But a person who owns 2,001 million pays 25%. So there is no relief given for that margin of 2 rupees exceeding or rupee exceeding 2,000 billion. Now, the other thing is that companies in a group which otherwise wouldn't have paid the tax if their income was less than 2,000, now will have to pay even if their income is 100 rupees. So that is the way in which this tax will work. Privacy is deeply disturbed by this particular tax. The reason being that the rate is 25%. It doesn't take into account your exporter, your 14% rate, or agriculture person or manufacturer, 24%, everyone pays. Number two is a disincentive for performance. So they are saying that if companies, some companies after so many years of being business have just earned 2,000 million, they're so happy about it that they have surpassed 2 billion. But now they've been punished for earning 2 billion. So that's what they're saying. So that's the view of the private sector.
However, there are concerns over the EPF and ETF also being covered by the bill, especially with the two funds containing public money.
One significant feature in this bill is the fact that they have brought the provident funds, largely the EPF, the ETF and other private provident funds that earn over 2,000 million in 2021. Generally, provident funds, saving societies are considered to be saving funds, employees' life earnings, and namely people don't tax those incomes in such proportions. Now, one might say, how is the EPF getting taxed here? Now, if you look at this act or this bill rather, it says it's taxed on individuals, partnerships and companies. And bill goes on to say company means the same definition as per the Inland Revenue Act. Now, under the Inland Revenue Act, a company includes a provident fund. That is how provident fund gets caught under this. So, unfortunately, provident funds get caught under this. And mind you, some of the provident funds have already distributed their income to the employees who retired from the fund with 20 and now. So, therefore, the additional cost will be borne by the person who's already in the fund. So, this 25% is substantial. EPF, I think, is about 65 to 70 billion in my view. So, it might take away about 5%, 6% of their distribution per annum, is my view.
In the meantime, the Cabinet co-spokesperson Dr. Ramesh Patirana had this to say about the EPF and ETF coming under the bill.
එක්වතාවක් පමණක් සිදු කරන බදු අය කිරීමක් හැටියට තමයි මේ බදු පැනවීම සිදු කරලා තිබෙන්නේ. ඒ නිසා ඒ සම්බන්ධයෙන් ඇත්තටම මේ රාජ්‍ය ආයතනකින් බදු අය කිරීම පිළිබඳව දැනට නිශ්චිතව එම වැනි කාරණයක් හඳුනාගෙන නැහැ.